We've seen some interesting movements in gold over the course of the last couple of weeks. At one point, it looked as though it was going to break above $1,800, but really failed, or really struggled, I should say, to hold on to these moves. A couple of weeks ago, on Friday, it looked as though we were going to see a close above $1,800. It gave these back late on in the day and closed a little bit below. The following week, again, it looked as though we were going to see a push at those $1,800 levels. And once again, it just failed to break that key level to the upside, and again, ended the week below $1,800. So we were seeing signs already that maybe the gold rally, the gold recovery was starting to run out of steam, and that we could potentially see some moves to the downside start to pick up a little bit of and we've kind of seen that now over the course of this week. Now, in the run up to the Fed meeting, we were seeing gold pull back quite aggressively. Now, that was potentially on the expectation that we were going to see some hawkish commentary, which never ultimately materialized. But I mean, while the gold charts have looked a little bit messy on the daily side, the shorter term charts do look a little bit clearer. Now, actually, if I bring up a chart while we're mentioning that, you can see on the daily chart here that yes, the price action looks a little bit choppy. It does highlight the fact that we did see resistance around that $1,800 level. It also shows that 233-day simple moving average band potentially weighing on that recovery trade as well. But that failure at $1,800 was quite clear and did lend itself to the idea that we could potentially see a pullback. Ultimately, over the course of the last month or so, price action has been very choppy, which I think is very evident from the daily chart as well, which is why I mentioned the lower time frame charts, because sometimes that can just clear things up a little bit. And as you can see on the 4-hour charts, it does look a little bit more clear. You can see the lack of momentum going into that $1,800 level. You can see that it was struggling around those points as well. You can also see as well that there was that rising channel that the pair had the commodity had traded in during that recovery trade from early October. And what we saw was a strong breakout last Friday, a strong break lower in gold. That coincided with the employment cost index release in the US, which rose to a 31-year high, suggesting that inflationary pressures were starting to filter down into higher employment costs, which is typically associated with more prolonged periods of inflation rather than transitory inflation. And that's why that took caused such a jolt in the markets, in the US dollar and in gold price as well. So we broke below that rising channel that you can see in the 4-hour chart, and we came back to 1770, the 200-233 period simple moving average on the 4-hour chart. From there, we recovered higher, but we continue to see resistance around the lower end of that rising channel, again, providing potentially some confirmation of the initial breakout of that. And that also coincided with a couple of key fib levels, which are not on the chart because that has been adjusted since the yellow metal made a new low. And from that point of resistance on that rising channel, we've rotated lower once more going into the Fed meeting, where we've made new recent lows just below 1760. Now, we corrected back once more again today. We've seen since the Fed meeting, like I say, there wasn't an enormous amount to gain, I think, from it. The tapering announcement came as expected, in line with expectations, phasing bond buying, net asset purchase out over the course between now and the middle of next year. There wasn't really too much either on rate hikes. The term transitory was used, but the language around it was very slightly tweaked. And what we've effectively seen is yields on the shorter end of the yield curve around 2 years, pulling back a little bit. On the longer end, not so much. And perhaps that's just reflective of the fact that the market's starting to think that maybe the Fed will continue to move a little bit slowly. But we have seen gold pull back today and push back towards that 1780, 1790 kind of level. But once again, it is running into some resistance where we've got the 55.89 moving averages. Again, a couple of key fib levels around that point as well, the 50 and 61.8. That's from the most recent highs when it peaked just above $1,800 to yesterday's low. So that's going to be a really interesting point, I think, for gold. A rotation off those levels again would be further confirmation of the kind of bearish twist that we have seen in the gold market. 1760 then to the downside remains key. The most recent low 1740, 1720. Below that, also interesting areas of support, having been interesting areas of support and resistance on the way down and on the way back up again during that recovery in October. But ultimately, as I said, from the daily chart, you can see that this is still a very choppy market. And I think that's going to continue to be the case because of the inflation outlook, the reluctance of central banks, and the changing interest rate expectations that we're seeing quite regularly in these markets. That's creating quite choppy conditions for something like gold, and I expect that to continue. But potentially we're seeing a bit of a downtrend unfolding in the yellow metal in the near term, but as we've seen plenty over the last month or so, that can quickly change because of that choppy market which I've just been alluding to.